Now, I am going to tell you the secret to public speaking. How many of you are afraid of public speaking? Oh, come on, be truthful, right? Most of you. Here's what you need to know about public speaking. You've probably heard this piece of advice before. Picture your audience naked. Is that good advice? No. Either because if they're attractive, it could be a problem, right? If they are repellent, it could be a problem. Either way, you're not going to be thinking clearly, and clear speaking requires clear thinking. So I'm going to give you a piece of advice that will always improve the clarity of your thinking. It's a two-step process. Step number 1, go to the bathroom. Nobody thinks clearly on a full bladder, so go to the bathroom. Number 2, make sure you've got your pants zipped after you've gone to the bathroom. Now I'm going to step over here behind and check. Because now, okay, there we go, we're good. Make sure you've got your pants zipped. You'd be amazed at how much more confident you will be if you'll just do these 2 things. Questions? Okay, now if I recall correctly, we were talking about the goal of financial management, and we said you shouldn't be looking for market share. We talked about how General Motors led itself to ruin chasing market share. We said minimizing costs is a bad idea because it can lead to reduced quality or value to your consumers, and they may walk away, and so it may be a short-term boost at best. Now, what about maximizing profits? Does maximizing profits sound good? It sounds good, but I'm going to have to ask my accountant here. Research and development expense. Do we take that charge when it's incurred, or do we get to spread it out? No, she's wrong. Yeah. Oh my, our educational system is failing us deep in here. Okay, so here's the trick with research and development expense in the United States. You're probably thinking about Europe. Yeah, in the United States, we have to expense that when it happens. Now, I have the new iPhone 17 Air. Have you seen that thing? Oh, for shame, she's late. Have you seen the new iPhone 17 Air? It's sexy. I mean, it's nice. And hey, they've been working on that for a year or 2. So that means they've got a year or 2 of research and development expense already charged off against that thing. And they haven't sold a single one of them yet. And they won't be selling any until like 9 months from now. And so you say, well, wait a minute. One of the ways that we could minimize our cost is to simply stop doing research and development, and you'll immediately have a nice boost to your numbers because you're no longer expensing that R&D. Does that make sense? Now, what's the danger in doing that?
But quality.
Okay, so there's quality. What else? What is Apple dependent on to get people to buy new phones? They've got to find something new and exciting, because if they just come out with a different color, that's really not going to add that much to sales. Would you go in and trade off your phone and pay $1,000 to get one in hot pink? Probably not. Okay, now let's think about a company called Motorola. Have you ever heard of Motorola? Motorola came out in 2005, I believe it was, with a phone called the Razr, R-A-Z-R. Oh, for shame, he's late. Please come in and have a seat anywhere on the first 4 rows. This is actually first class seating right here. Oh yeah, there you go. Make sure your phone's off. Okay, so they made this phone, and oh my goodness, if you saw the phones that came before, you would realize that this Motorola Razr was the sexiest phone to ever exist up to that point, right? And it was quite interesting because they went through the roof. Sales went through the roof. My wife had a silver one, I had a black one. The former associate dean, Dr. Roselle, eventually they came out with a hot pink one and she got it. Okay, now, so what do you think's happening to Motorola's profits? They're up. And everyone assumes that it's because of the sales of this Razr, but in truth, it was that they had killed, as partially the sales, but they had also killed off their R&D. And so we're all waiting to see the next big thing from Motorola, and they come out with this thing. The Pebble. Because it was shaped like a rock. You know what that looked like in your back pocket? They might as well called it the turd, right? This thing was a total piece of crap. Now, what do you think happened to Motorola? Oh, and I had a student who's like, oh yeah, my sister had one of those. I'm like, did she like it? Just, no. Okay, so what do you think happened to Motorola sales? You guys don't even remember the turd, right? That tells you how many of them that they sold. Okay, so Motorola sales takes a huge dump, and this begins the downward spiral of the company. Motorola eventually gets in trouble, and they sell to Google. Google strips off the good patents and sells the remaining husk to a Chinese company called Lenovo. You can buy Motorola phones today, but they're just Lenovo phones with a Motorola symbol on them. They're no longer an American phone company. Okay, so minimizing costs may sound good in the short term, or maximizing profits may sound good in the short term, but you can destroy your business that way. What about maintaining steady earnings growth? I'm going to give you a choice here. We've got two different firms, firm A and firm B. And here is the earnings growth for them. 4%, 4%, 4%, 4%. And over here we have another firm that's 13%, 2%, 19%, 7%. Which one of those firms has steady earnings growth? This one over here? Which one would you prefer to own? This one over here. So maintaining steady earnings growth is not the goal. So the goal must be the only thing left on the page, and the only thing left on the page is to maximize shareholder wealth. Maximize shareholder wealth. And if you read the rantings and rantings of idiots, you will hear people say, oh, the greedy shareholders, and they're just really against this concept of maximizing shareholder wealth. Let me tell you why it is best for not only the shareholders, but for society if we can do that. And here's why. Let's think about the way cash flows get distributed at the firm. When the firm makes money, the first people in line, always the government. The government, what do they get from the company? Taxes, right? Now does the corporation paying taxes benefit you? Oh, come on. Y'all didn't think that money was coming out of thin air, did you? Right? Someone's paying that, or will end up paying it down the road. Okay, so the corporation pays taxes, and then they pay their employees, they pay their suppliers, they pay their bankers, they pay their bondholders, and they pay, if they're preferred shareholders, which we'll get to way later, if they'll pay them. And at the very end of the line is the common shareholder, and that's the one we're talking about here. We're talking about maximizing common shareholder wealth. Now, here's the thing. If I am making the person at the end of the line rich, they have a residual claim. They only get money if there's anything left over after paying all these other people. If I'm making this guy rich at the end of the line, what does it mean I've done for all those other people? I've paid them what I owe them. Does that make sense? And so if I said that we're going to do this to maximize the wealth of the bondholders, that wouldn't quite make as much sense as saying the common shareholders who we need to maximize for. Okay, so how many ways are there to say this last thing? Too many. So first of all, there is maximizing the share price would be another way to put this. Maximizing the common share price. You could write these down. Maximizing the common share price. Another one would be maximizing the market value of the equity. Maximizing the market value of the equity. By the way, the market value of the equity is just the number of shares times the share price. So once again, maximizing the share price gets us there. Now, your book probably has 2 or 3 other examples. You should know them all, and here's why. Because I'm going to be giving you a multiple choice exam. There are 4 different versions of that question. Do you think they all have the same correct answer? No, they all say the same thing, but in a slightly different way, you know, because some of you all are cheaters and you would get in there and muck around. Anyway, so we're not going to do that. You guys need to learn that. Now, one of the ways, and I always have students that they're like, well, I knew that was the answer, but I thought it would be better to maximize profitability. And then we have to take the walk down Motorola Road once more, so they understand that that's not what we're trying to do here. Questions? Okay, now, this is an issue between management and finance. In management, you will also always hear people talking about, well, it's not just the shareholders, we have to look out for these other stakeholders. Well, what are stakeholders? Stakeholders who have an interest in what's going on at the firm may not be financial. Maybe, maybe not. So, for instance, the employees have an interest in what's going on in the firm, but they are probably not shareholders. And I'll explain to you why they shouldn't be later on in class. Then we have our customers. Do the customers, oh, for shame, he's late. I told you I would shame you. Okay, so customers. Do customers have an interest in what's going on at the firm? Absolutely. What about our suppliers? What do our suppliers want from us? They want to be paid, right? They want to get paid. Okay, because they're sending us the stuff on credit. They want to get paid. So yeah, they've got an interest in what's going on. And of course, the government has an interest in what's going on. Taxes, environmental concerns, those sorts of things. In fact, we may see the environment listed as a stakeholder. Now, so far so good. It sounds like we need to be doing right by every single one of these groups, and I agree. But by focusing on maximizing shareholder wealth, we can take care of all these other things. And I'm going to tell you that if you give managers more than one goal, which one do you think they're going to focus on? The easier one. So I tell you folks, I'm going to give you two goals in this class. One is to maximize your point value. The other is to minimize your carbon footprint. Now, every time how many of you drove to class today? So you could minimize your carbon footprint by skipping class, right? And so you guys start skipping class and I'm like, hey, and I call you because I'm concerned. I'm like, what's up? You're like, well, I'm minimizing my carbon footprint. I'm like, well, what about that other thing? Oh yes, we're planning to work on that next semester. I'm like, well, you're gonna be paying for the class again, right? That's not good. Do you see how this works? If I tell people, if I give managers these goals other than maximizing shareholder wealth, then you will see they get distracted and they start doing things that don't necessarily benefit the shareholders or society. So let's talk about what would happen if I treated employees badly. My accountant comes to me and says, hey, I'm sorry here, our expenses are too high. We need to cut our costs. I'm like, okay, where do you think our costs are too high? And he says, I think labor, we're spending too much on labor. And I say, okay, how are we going to reduce the labor that goes into our product? He says, well, engineering tells me that we can't. I said, well, then who are we going to fire? How are we going to reduce our labor costs? He says, I know, we'll just cut everybody's pay in half. Miss Sego, what do you think is going to happen?
They're not going to be very happy.
They're not going to be very happy. Now, and go ahead. They might leave. Now, it's not just going to be the random ones that leave. It's going to be the good ones that could get a job somewhere else. So who do I get left with? The bad one. I'm going to teach you a new term here today. The cream of the crop. That's who I'm left with after I cut pay in half. Now, the half that are left, they're bad workers, they're demoralized, and I think, aha, I know how I can fix this. I actually know a guy who has this leather suit and a whip, and he'll just go around and try to incentivize these workers to work harder, right? Now, not only will more people leave, I'll probably get in trouble with the government, right? Because that's, I believe, illegal. I don't know, maybe some people are into that, but this is not, we're not gonna do that in the workplace. Now, do you see how if I don't take care of my employees, by the way, what do you think's happening to my share price through this whole thing? Right? Got to take care of the employees. Now, let's talk about customers. If I treat my customers like crap, what happens? Yeah, they stop buying my stuff. They stop buying my stuff, what happens to my profits? And then what happens to my share price? Okay, now let's talk about suppliers. If I don't pay my suppliers, what do? Yeah, they stop sending us stuff. If I don't have anything to sell, what happens to my sales? What happens to my profits? What happens to my share price? Straight into the toilet, right? So I got to take care of my suppliers. What about the government? What can the government do that nobody else up here can really do?
Shut you down.
Yeah, they can just come in and shut us down, and I'll tell you a story about my run-in with the Ohio Department of Natural Resources when we get to capital budgeting. So we got to take care of the government. And in fact, let's talk about the environment. So here's the deal with pollution. I'm going to tell you this very clearly, and I want you to hear this, understand it, and write it down. It is cheaper to prevent pollution than to clean it up. It is cheaper to prevent pollution than to clean it up. I was involved in a project to clean up an old plant site. By the way, we bought this plant. We didn't realize it had been used to dye carpet, and it was just really contaminated, and we spent a lot of money to clean that up. Now, just a more practical, personal example for you. Here's what I want you to do. On the way home tonight, I want you to pick up two 2-liter bottles of cola. Cheap stuff, but not diet. You gotta get the real stuff. Okay, now I want you to take one of those, and I want you to open the lid, and I want you to carefully pour it down the sink. That's my example of controlling pollution. I want you to take the other one and pour it out on the carpet in your living room area. And then I want you to tell me how easy it is to clean up. You guys ever had this situation happen to you? That's never coming out, right? You think you get it clean, and guess what happens? More of it, more. My point to you is it's a lot cheaper to take care of the environment than to adulterate it. Now, I used to teach China EMBA, and I'd have Chinese students who are like, oh no, in our country we just pollute, no one cares. That's changed now. Now they're sending people to prison for polluting. So eventually it's gonna come back to bite you. So we gotta take care of the environment. Now, by taking care of the shareholders, oh, by the way, if the news comes out that I've had a big old pollution issue and I'm gonna have to spend a bunch of money cleaning up the site, what happens to my share price? Boom, right? So if I'm maximizing shareholder wealth, I'm gonna be taking care of all of these things. And I'm only gonna be giving managers one goal, because managers are humans, and humans are simple animals. We really can't handle more than one goal. Questions? Okay, now let's talk about a little bit about regulation. United States, if you roll back to the late 1920s, 1929, we had the stock market crash. And at that point, there was very little regulation. And so, and it actually took us like 5 years to come up with this. 33 and 34, we come up with the Securities and Exchange Commission, the Securities and Exchange Act. And we started saying things like, well, hey, wait a minute. Maybe we should make these people disclose pertinent information if they're going to be accessing the public markets. Because up to that point, firms didn't even have to issue financial statements. They just put their stock out there and you buy it and you take the risk. Now, apparently that didn't quite work, because we move up to 2000, 2001, we have WorldCom, we have Enron, and so the government says, whoo, apparently we need to tighten this thing up a bit. And so we did Sarbanes-Oxley. And what Sarbanes-Oxley did is still saying you've got to report it, but now the CFO and the CEO have to sign that the financial statements are correct under penalty of prison. What do you think happened to the quality of financial statements at that point? Probably got a little better, right? Because it used to be, so the people that got in trouble previously didn't perhaps go to prison. Now let's talk about another piece of regulation we have, and that trading on inside information is illegal. Let's talk about what inside information is. It's material, non-public information. Material, non-public information. So I was at Halliburton headquarters, and the president of vice president of international something or other came in, and it was all guys in the room. He says, "Gentlemen, I can't tell you what tomorrow's earnings numbers will be, but I can tell you to buy the stock." Now, what's he really saying? Tomorrow's earnings numbers are going to beat expectations. What do we expect to happen to the share price? It's going to go up. Now, do you think I invested on that? No. And here's why. That was material, non-public information. That would be a violation of the law. The United States has had this prohibition for a long time. Other countries have been later to adopt it. I have a Korean friend who has a PhD from the same place that I do. And when he first went back home with his PhD, he didn't become a professor. He went into investment banking, and he made millions trading off inside information because it was not illegal in Korea at the time. Then they made it illegal, and my friend went back to being a professor. Why? Because he was already filthy rich. And two, he was no longer able to enjoy, what he was previously, so he quit that. Now, when you trade on inside information, you're like, I made an extra $1 million. Who gets hurt? How about every other person that would have liked to have known that information and been able to trade on it? Or let's say that the inside information is bad. I've got a discussion up about Carvana. Anyway, so basically it's pump and dump, right? They're putting out all this good news, and in the meantime, so it puts the share prices up. The managers know that the hammer's about to fall. They sell their shares, and then they announce the bad news. That's insider trading, right? Who else would have liked to have known about that? How about every other shareholder at Carvana? And the next day, when the news hits, Carvana shares just take a huge dump. And those people are the ones that are providing this profit to the insiders. Now, complying with regulation is costly for firms. And in fact, what we saw after Sarbanes-Oxley is we actually saw some firms going dark. So going public is when you IPO. Going dark is when you take the company private, you buy up the outstanding shares, and then you no longer publish your financial results. And so there were a group of companies that would have remained publicly traded had it not been for the extra expense of complying with Sarbanes-Oxley. In finance, we love to make fun of accountants. You guys probably have already figured that out. But one of the things that we say is, what does an accounting scandal always lead to? Greater employment for accountants, right? Because now to comply with Sarbanes-Oxley, we have to have extra accountants, right? And so they're creating the demand for their own work. It's kind of sick. Questions?
So who are the ones regulating the insider traders, like board of directors?
Well, so the board of directors should be keeping an eye on this sort of thing. But when you use the word regulating, now we're talking about the government, and it's the SEC.
So they're the ones auditing them to see if they are insider trading, or how are they?
Okay, so insider trades at corporations of true insiders have to be reported. But they don't have to be reported until like 30 days after the fact. And so we can see all this in the rear view mirror. Now, as far as I know, you're not on a board of directors or CEO or right? You could still, if you had a friend who was at Google and you learned something, you could still trade on this. Well, what do? They have transaction records, and they watch for these odd patterns of transactions. Now, do you think they have enough resources to go after everybody? No. So who do they go after? They go after the people who will make headlines. The Chinese have an expression, kill a chicken to scare the monkeys. Have you heard this? All right, thank you. I appreciate you testifying on my behalf. Kill a chicken to scare the monkeys. You know, hey, these monkeys are valuable, right? I don't want to go around killing all these monkeys, but I'll tell you what, I'll grab one of these chickens, whoop, and now the monkeys know who's in charge, right? Kill a chicken to scare the monkeys. Now, what does the SEC do? Well, they have to occasionally find a chicken. And sometimes the chicken is Martha Stewart, right? Right? Chicken. Martha Stewart was definitely a chicken. Then there was a 15-year-old boy. Now, why do you think they would pick a 15-year-old boy over a middle-aged finance professor?
It's gonna make the news.
It's gonna make the news. 15-year-old wonderkind, charged with insider trading, right? Once again, he's the chicken. Y'all are the monkeys, right? But what do you monkeys know now? Don't insider trade. Does that make sense? Okay.
Do you consider United States senators invest in the stock market insider trading?
Oh, absolutely. And so you're a member of the Senate Select Committee on Manure, right? And inside of your committee, you hear something that's going to cause the price of manure to go through the roof. You immediately step outside and call your broker. By the way, is that material non-public information? Hell yes. You step out and you call your broker, you're like, get your hands on all the shit you can, right? Because manure's going to go through the roof. By the way, members of Congress are the only people in this country that are exempted at current, right? They're trying to get through legislation to make that stop. Nancy Pelosi is apparently a financial genius, right? It's just amazing. In fact, there's a guy that started a new fund, and all he does is invest in exactly the same things as members of Congress. Now, is his returns going to be as good as Nancy's? Absolutely not, and here's why. You remember you heard the news that manure prices were getting ready to go through the roof. By the time it gets published, what you've bought, that you're like neck deep in manure, the price of manure has already gone up, right? And so you may catch some of that rise, but you won't catch all of it if you're like following those trades afterward. Would I recommend investing in this guy's fund? No, simply because that news has already been put into the stock price by the time he invests in it. Good question. Other questions? By the way, you can't trust the government. Why? It's a government of the people, by the people, and for the people. And what do we know about people?
They're scumbags.
Scumbags, right? Does this make sense? So it's a government of scumbags, by scumbags, for scumbags. Questions? Oh, and by the way, is that, you say, well, yeah, the US, it's absolutely true, but not in my country. No. Your government is composed of people too. Okay, questions? Okay, now we're moving on to the agency problem. Okay, we're going to get into the agency problem here, and the agency problem is where people expend other people's resources differently than they would expend their own. And we're going to talk about some of the things that we had here to try to control that. We're going to talk about corporate governance up front, then we're going to take a deeper dive into the agency problem. First of all, we know that the equity holders in the firm are the decision makers. And they the shareholders elect the board of directors. Why? Because we can't get all 1 billion shareholders together every day to make decisions about what to do with the firm. And in fact, the 12 directors that we elect can't do that either. They're going to meet somewhere between 3 and 6 times a year, maybe 12 if things are bad. And they're not going to be able to control things day in, day out either. So what are they going to do? They're going to hire, compensate, and fire managers. Now, hiring, we're going to go out and find the best person for the job. Compensating, we're going to come up with ways to incentivize them to do a good job for the shareholders. And then firing them. If things get bad, then we need to be able to fire that CEO. Now, why do I tell you all about that? It's because we're coming down to this question of having the CEO and the chair of the board be the same person. These are two different roles, by the way. Remember, the board of directors are elected by the shareholders, and the CEO is hired by them. If the board is supposed to hire, compensate, and fire the CEO, what do you think happens when the CEO is now chairman of the board? Let's assume that I am a CEO and a chairman of the board, and I come in and I give my update as CEO. And then I say, okay, now I'm taking off my CEO hat and I'm putting on my chairman of the board hat. Let's talk about that CEO. Isn't he a great guy? Oh my goodness, I think he needs to have like a 50% raise and double his bonus. Don't you think he is wonderful? Now, other people in the room may know how bad I am at my job, but by the way, we all play golf together. Do you think the board's going to be as hard on this person as they should be? And it's especially hard if he's or she is the chairman of the board. Does that make sense? And so in most countries, a lot of countries, they're already saying these cannot be the same person. And that's smart. In the US, we don't regulate it, but companies have been moving away from it. One notable exception, Caterpillar. Caterpillar divided those roles and then they put them back together. Why? I have no idea. But it's definitely a conflict of interest because now you've got the CEO advocating for A, raising their pay, and B, not firing them. By the way, do you think CEOs get fired as often as they should? No. Which is good news for you if you're a bad CEO. Okay, so let's talk about the agency problem. It's when people expend other people's resources differently than they would their own. Yes, ma'am?
So what if the CEO is the owner of the organization?
You know what? If the CEO is the 100% owner of the company, I think it's perfectly fine because there is no conflict of interest. Because let's think about this. If the CEO wastes $1 of the firm's funds, whose money is he or she wasting? Yeah, their own. I don't give a flying fig what that person does, right? Does that make sense? And they're only hurting themselves. But we're getting around to where we're going to talk about when people help themselves at the expense of others. Okay, so where does this problem come from? First of all, the separation of ownership and control. In your example, where the CEO owned 100%, there was no separation of ownership and control. They were perfectly aligned. But when you get into corporations where they have what we call atomistic shareholdings, by the way, I own 1/1000th of GE, right? I own 1/1000th of GE. Do you think that I have as much pull on this person's behavior as, say, someone that owned 99%? Right? No, of course not. So it's all spread out there. I'll give you an example. My sister is a good person. I want to get that out of the way before we start here. But my sister is, after all, still a person, right? And we know about people. Okay, now, I go to visit my sister at her house, and she has this huge curved monitor. It's just like, and it looks like it's floating in midair. I'm like, holy crap. I'm like, that's amazing. I said, how much did it cost? And she told me, and my jaw dropped. And she says, whenever I'm buying something, I always say, what's 25% of that? And is it worth it to me? Why is she saying that? She is in a 4-way equal partnership. When she wastes $1, it only costs her how much? 25 cents. Now, you may think, aha, she's pretty smart. She's figured this out. What do you think about her other partners? What do you think they're doing? Same thing. So what does that mean for the overall profitability of the firm as a result of this behavior? It's lower than it should be, right? Now, think about this. We're talking about 4 people. Now, she and her partners sold out to another company. but they held a small shareholding. Let's say each of them has 10% now. Now when she goes to look for a new monitor, what is the number she multiplies by? 0.10, right? In fact, it makes the math easier, right? This is a $5,000 monitor, 500, woohoo, we're good to go. No, once again, my sister is a decent human being. This is just how people think. Okay, now we've taken it from being 4 people to being, say, 10 people with equal shares. What happens when you have millions of shareholders? Now suddenly you've got someone over here controlling the expenditures of the firm that probably owns very little of the firm. And so we see, and by the way, this is a great test question. We see that the agency problem is worst at publicly traded corporations. The agency problem is worst at publicly traded corporations. And the reason why is that the control is in the hands of a very few people, the control of how the money gets spent, but the money belongs to a bunch of people out here, a bunch of people out here. Now, let's say that I can figure out how for GE to save $1 billion. Is it even worth it to me to pick up the phone to call the CEO of GE and make this suggestion? Absolutely not. Because what is 1/1000th of $1 billion? It's $1, right? It's $1. I'll still still stoop to pick up $1 off the street. I will. Quarters, nickels, dimes, pennies, no, not anymore. But I'll still do $1. But will I pick up the phone and wait on the phone for 25 minutes so I can talk to the CEO of GE? Hell no. And so what we see is we've got all these small shareholders that don't have the inclination to hold these people accountable. And so we see a bigger problem at corporations. Questions? So, how does the agency problem manifest itself? First of all, wasteful spending. Wasteful spending. We see this a lot. Have you guys seen Apple's headquarters that they built? It looks like a spaceship, right? And by the way, is that cheap real estate where they built? No, right? So they built this spaceshipy thing, and do you think they really needed that? Absolutely not. I do enjoy Walmart. Walmart has finally built a new general headquarters. When I worked for Walmart in 1993, Walmart general headquarters was in an old warehouse. And it was a total piece of crap. And people would say, you know, the world's largest retailer, you should have a better place. And I think there may be some truth to that. So now they finally have a better place. Do you think it's anything like Apple's? No, because they still have better control of their spending. Now, are they perfect? Of course not. Okay, let's talk about, oh, by the way, do you think this comes down to the rank and file too? Do you think that ordinary employees have a problem with spending the company's money more freely? Let me tell you about when I first got my job as a salesman, I was told that my boss, Bob, would be going out with me on my first trip to meet my customers. And I said, that's great. Bob has been in this business for a long time. He knows this much better than I do. I could learn lots and lots of things from Bob. And I said this in front of the other salespeople, and they laughed. I said, what are you laughing about? They were like, nah, that's not why Bob's going with you. I said, why is Bob going with me? And they said, well, your first night out, Bob's want to go to an expensive restaurant, and they told me exactly what was going to happen, and they said, and then he's going to pass you the bill. And sure enough, we get to Atlanta, we check into the Hampton Inn, Bob fills his pockets with some cookies that are there, and then he says, meet you down here in 5 minutes, we'll go to dinner. And so he comes back down and he asks the girl behind the desk, where is a good steakhouse? And she says, do you want a good steakhouse or do you want a great steakhouse? What do you think Bob says? I want a great steakhouse, because after all, is Bob paying? By the way, Bob owns 1% of the firm. That becomes important here in a minute. Now, we go to the steakhouse, and here's how you can tell a good steakhouse. Number one, everything is a la carte. Your stuff doesn't come with a potato or anything. You've got to order everything separately. Number two, They have a person that comes around and cleans crumbs off of your tablecloth with a little blade, a chromed blade, or maybe gold. And number 3 is they will bring you a napkin to match your pants. And we got sat down, and I put my napkin in my lap, and this guy goes, whoop! And I said, Bob, that bastard stole my napkin. He says, don't worry, he's gonna bring you one that matches your suit. And he did. He had a charcoal gray napkin just for me, right? Okay, so this is a good steakhouse. Now, and keep in mind the year is 2002, so put prices in perspective. The server comes to our table. She is visibly 8.5 months pregnant, and Bob starts flirting with her. Folks, that's not appropriate. Okay, now she's visibly 8 months pregnant. Bob starts flirting with her, and he says, what do you recommend? By the way, the server, what is she expecting when this is all said and done? A tip. And how much, percentage-wise, do you think she's expecting? 20. She's saying 20. I'm gonna say 15 because she knows how this works, right? Okay, so she's expecting 15%. 15% of what? Whatever she can sell us, right? And so she says, well, you know, for the discerning customer, such as yourself, I would recommend the manhole cover. Bob's like, whoa, what's the manhole cover? She's like, it's a 72-ounce steak the size of a manhole cover. It won't even fit on the damn plate. And Bob's like, you got me. I got to have that, right? And then Bob proceeds to order every one of the side dishes, even asparagus. By the way, asparagus is sad and limp and disgusting, but it's expensive, right? So, and then he also orders a bottle of wine. Did he get the cheapest bottle of wine on the menu? No, he didn't. By the way, the best value wine on any menu is always the second one from the bottom. Why? They know you don't, or actually it's the worst value, sorry. It's the worst value. They know you don't want to look cheap in front of your friends, right? So what are you gonna order? The second cheapest one, and that is the worst value on the entire wine menu. So you're getting lots of things for your tuition today. Okay, now, so it ends up, the bill is around $300, and that's 2002 money, so like double that. So Bob, as always, pushes, as they said, he pushes the bill over to me. Now, do you think I'm paying? No, who's actually paying? The company, and that means the shareholders, right? And so I have no problem getting my company card out, whoop, throw it in there, and of course Bob says, give her a good tip, she's got a kid on the way, right? So give her a good tip. So, oh yeah, he's a great guy. Okay, so I could tell you Bob stories all day long that would make you blush. So back to the story. So let's say it was $350 when we get all said and done here. How much did that meal actually cost Bob? Remember, I told you he owns 1% of the firm. $3.50, right? 1%, $3.50. Which, by the way, is what Bob would spend at Taco Bell when he was eating on his own dime. Because you could eat at Taco Bell for $3.50 back then. Do you see how this works? Now, am I telling you to be that guy? No, but you need to be on the lookout for that because the people that you're investing in are engaging this behavior. The people who will work for you are engaging this behavior. Now let's talk about why it was important for me to put it on my card instead of Bob to put it on his card. Who approves my expenses? Bob. Who approves Bob's expenses? Bob's boss, right? Do you think Bob's boss looks at expenses 2 levels down? Absolutely not. Okay, so that's wasteful spending. Any questions?
Why is eating nice encouraged then? Like, oh, treat the new supplier, treat the client, or they encourage the big bill?
Is it the owner encouraging it? Probably not. Yeah, and there is something to be said for treating your employees decently. So for instance, when I worked for Walmart doing expense reports, they were allowed $5 for breakfast, $10 for lunch, and $15 for dinner. And that was it. And if two people were on the road together, they had to share a motel room. Can you imagine that? I'm not going to go that far, right? But on the other side, there is extravagance, like Bob. Bob and I are just schmo salesmen. There's no reason we should have been running up a bill like that at the manhole cover joint. Good question. Other questions? Okay, let's talk about empire building. Who do you think is more important? The CEO of a company with 100 million in sales or the CEO of a company with 200 million in sales? 200 million. Who do you think gets better tee times at the golf course? 200 million. Who do you think has a more attractive mistress? 200 million, right? So we all know that it's better to be the CEO of a bigger company. Now, here's the problem. There are ways to expand the company that do not maximize shareholder wealth. We call them value-destroying acquisitions. I'll give you an example. Back in 1998, I interviewed with a company called Eaton, E-A-T-O-N, and they make industrial stuff. So they make electrical switchgear, they make hydraulic motors, all very boring industrial stuff. But they have one division called the golf grips division. Do I have any golf players in here? Any golfers? What is a golf grip?
Grip at the end of the club.
Yeah, it's not industrial equipment, is it? It's just the grip at the end of the club. Now, why do you think, by the way, does that fit with the rest of Eaton's business? No! Why do you think this company went out and bought a golf grips division? I'll get you started. Because the managers like
To play golf.
to play golf. And now that we have the golf grips division, we can hold our directors' meetings at Hilton Head. By the way, Hilton Head's famous for golf. Well, we've got to try the new product from the golf grips division. It's part of our fiduciary responsibility, right? Do you see how this works? I was working for a company, and it was in this case, it was a family-owned company, so it wasn't as bad. And we were looking for a new factory. We're going to expand into Europe. And so we sent a team over to, and I was unfortunately not on the team. They sent a team over to, and they talked to like 7 or 8 all over Europe, 7 or 8 locations. And the one that they found that was the absolute best was in Belgium. And in this part of Belgium, the people spoke English, so there wasn't going to be a communication problem, and all was good. So they came home and they said very adamantly, we need to go to Belgium. And the CEO said, okay, thank you for your recommendation or your suggestion. By the way, when they say your suggestion, what does that mean they're going to do? Yeah, whatever the hell they want, right? So what did they do? Well, with the factory ended up in Manchester, England.
Ew, why? I'm from there, I can say that.
Very good. Okay, so first of all, usually students are like, oh, the CEO is a Manchester United fan. No, not really. The CEO liked playing golf, and it's just a hop, skip, and a jump up from Manchester to the old course, St. Andrews, Scotland. Oh, it's a nice train ride.
Yeah.
Oh, the trains broke down.
Yeah, it's not pretty good, they're reliable.
Oh, so hopefully, apparently they've improved since 2013 when I was there last.
Yeah.
Oh, good. Okay. Because they sucked. Okay, so back to the story. Does that make sense? To build a factory somewhere just because it's close to or a nice golf course? No. Now, fortunately, in that case, there weren't a lot of shareholders he was hurting. It was just him and his brother and his sister and stuff like that, right? Okay. Now let's talk about shirking. Shirking, you may have never heard of shirking, but shirking is the opposite of working. Shirking is the opposite of working. Okay, so I had this guy named Roy who worked for me in Dallas, Texas. Roy was a machinist. And whenever I would see Roy walking from his machine, which was a lathe, walking to the tool crib to get new cutting tools, this is how Roy walked. He's real relaxed, right? And Roy would get down to the tool crib and he's like, hey, Mr. Tips, He says, how's the wife and kids? Did you go fishing last weekend? Me too, man. I caught the biggest bass I've ever caught. I would have taken a picture, but it got away. Roy's also a liar. Okay, so now, then Roy does this. He says, well, better get moving before Haggard sees me. And he gets his tools and he slowly makes his way back to his machine. And this is just the way Roy was. So one weekend, my wife and I are out driving around. I happen to know where Roy lives. I also happen to know that Roy has his hobby is racing go-karts. I'm like, Roy, you're a 45-year-old man. Why are you racing go-karts? So he's, I really enjoy it. Well, anyway, but I see Roy, and he's in his backyard, and he's working at his go-kart, and it looks like this. He gets over here, and he's moving with purpose and with speed. I slam on the brakes. I'm like, honey, there's something wrong with Roy. Now, why was Roy working with such purpose on his go-kart, but he's such a slacker at working for me?
At work, he's paid by the hour.
Yeah, he's getting paid by the hour. At home, he's getting 100% of the benefit of his labor. At work, any benefit he creates over and above what it takes to keep from getting fired, that benefit goes to me, right? Or the company, the shareholders, right? And so Roy was a world-class shirker. And was he good enough to keep me from firing him? He was, right? He was like skating that line. I had to threaten his ass a couple of times, but he was skating that line. Okay, now, Roy was a person. He may still be alive. Let's say Roy's a person. What do we know about people? Scumbags. Okay, now, you say, well, wait a minute, CEOs. What about CEOs? CEOs are people, and people are scumbags. So do you think CEOs might engage in similar activity?
Absolutely.
Oh, yeah. Oh, yeah. In fact, you see it quite a bit. And it's especially true the closer the CEO gets to retirement. Because, first of all, they're probably not going to try to find another job after this one if they're going to retire. And the second one is, remember what we said about the board and being unwilling to fire people? All they've got to do is do enough to keep from getting fired. When we had the financial crisis, there was a company called Bear Stearns. And every time that another step happened in the crisis and they tried to get a hold of the CEO of Bear Stearns, any idea where he was at? Golf. Yeah, and they would call his phone. Mr. So-and-so's phone. Yeah, we need to speak to him. The world's coming apart. I'm sorry, he's told me not to be disturbed. Well, what's he doing? He's working on his swing. What the hell? Now, here's the fun thing about this guy. He was like in his 80s or 90s at the time, right? He should have retired a long time ago, but he was having way too much fun not doing work, right? By the way, who do you think pays for his club membership? Yeah, Bear Stearns. What happened to Bear Stearns? It's gone now, right? Do you think CEOs shirk? Absolutely. Questions? Okay, so how can we control the agency problem? Well, first of all, managerial compensation contracts. What do I mean by that? This is a good thing to write down. We want to make sure the CEO gets rich only when the shareholders get rich. We want to make sure the CEO gets rich only when the shareholders get rich. Now, how do we do that? If I just offer to pay you $1 million a year, regardless of the stock price, is that a good compensation contract? No, that's going to lead to a lot of shirking. And so what I want to do is give you some reason to care about the stock price. And so I could just give you a stock grant. By the way, Elon Musk, where does the vast majority of his wealth come from? Stock grants from Tesla, right? They gave him $54 billion worth of, right? Now, why in the world would they do that? Because they're trying to incentivize Elon to push up that share price. And once you own shares, then you start to care more. Now, Halliburton, right before I left, they were trying to retain me, and they pulled me in and they said, we're going to give you 10 shares. I'm like, whoa, I'm touched. By the way, this is my 2-week notice. They gave me 10 shares. Now, do you think that's enough to sway my decision making? No. But when you get into bigger and bigger amounts, it is. Now, let's talk about an even better way than stock grants, because stock grants are expensive. I'm going to give you $54 billion worth of stock. That's a cost of $54 billion to the company. What if instead I could offer you stock options? Now, how does an option work? The stock price is currently $20 a share. I give you the option to buy the stock next year at $25 a share. Does that option have any value right now? No, the stock, if I wanted stock right now, I could go out and buy it for $20. When does that option start to have value? When the share price rises above $25. And so I've got the CEO out there working to try to raise the share price. And basically that first $5 that he pushes or she pushes the share price up is free, doesn't cost me anything in compensation. After that, for every dollar that it goes up, the share price goes up, those options each gain a value of $1 a piece. And so this is how we can interest the CEO in pushing the stock price up without necessarily just giving them shares in the company. Now, what does the option allow them to do? Allows them to purchase the shares at $25 a share. If the shares were trading for $32, it certainly makes sense for them to go ahead and buy them at $25 a share. And typically what they do is that they then immediately sell off enough shares to pay for the, so they're paying that extra, that $25 that they had to basically throw in there. Does that make sense? So they're keeping the profit.
Is there a limit on the amount of stocks you can buy at that option price?
Yes, they'll say it's 100,000 shares or it's 300,000 shares. Oh, absolutely. Because what would you do otherwise?
Buy it all.
Oh yeah, if things were going really well, you're like, woohoo, right? You jump straight on that, you end up owning the company.
When it expires worthless, how does that come about?
Okay, so he's asking about options expiring. If it expires worthless, there are a couple of things that we can do as board of directors. Number one is we say, sorry pal, you just didn't cut the mustard here, right? Or we can reprice the options. Instead of 25 now, we're gonna make it 22. Because you did manage to get the shares up to 23. So we're gonna throw you a bone, right? And there's an argument over whether or not that's good. So if you've got options that are like way out there and things have happened and you know now that they are absolutely never gonna come to pass, does it make sense to reprice those options? Because right now they're not providing any incentive at all. Because the manager says, there's no way I'm ever gonna be able to do that, so why should I even try? Does that make sense? So they've got this rank here at the university called Distinguished Professor. And I sat on the committee for determining who was distinguished. And these people are turning in these binders this thick. And I'm looking at them, I'm like, damn. And we were like saying no to people that were really, really accomplished because we're only allowed to do 2. Now, after seeing that, what do you think happened to my desire to go up for Distinguished Professor? Right? Way down. And the extra stuff that I would have done perhaps to try to earn that, you think I'm doing that now? No, man, I'd rather have a nap, right? Does that make sense? Okay, next we have the managerial labor market. Y'all probably don't think of managers as being labor, but anyone who trades their time for money is labor. I am labor. You guys didn't know that. I am on the bottom of this organization. I'm down on the shop floor producing value here. I am labor. Okay, now, what is the managerial labor market? It turns out that basically every company needs a CEO, and there is not an unlimited number of people who are capable of doing that. As we have learned recently, competence actually is important. It is important to have people who know what the hell they're doing. Otherwise, your whole state may burn, right? You guys know about that? California, they've been mismanaging their fire reduction efforts for years, and the chickens have come home to roost. So it's important to have people who know what the hell they're doing. Now, so what that means that there is only a small pool of these people. And these people also are typically people who are known to the public, especially through publications like the Wall Street Journal. As a CEO, if you do something stupid, the Wall Street Journal will write an article about you. Did you guys know that? Please don't try that out for yourself, right? Don't do anything stupid. But if you do something stupid, they'll write an article about you. Now, does it necessarily hurt me in my current job? Remember, we said it's kind of hard to fire CEOs. The board, they play golf together after all. But what does it mean about the possibility of the next job? Right? I'll give you some really good examples because obviously this guy got fired. Dennis Kozlowski, I think was his name. He was the CEO of Tyco, and he did all sorts of crazy crap. And he was all over the Wall Street Journal, and then he got fired and he went to prison. Now he's out of prison. He's reformed, right? And he sends me a resume. He says, "Oh hey, I see you're hiring for a CEO. I'm available." Do you think I call him in for an interview?
Absolutely.
Hell no, right? Okay, so what we're saying is this managerial labor market may not control, it controls your behavior in your current job because of your thoughts of the next job. Now remember earlier I said if someone is getting close to retirement, that we can control them as well? It's because there is no next job for them. They're not scared of the managerial labor market. And by the way, they're probably old enough that even if we did cut them loose, they'd be fine. Then we have the market for corporate control. We're talking about mergers and acquisitions here. Basically, in order for me to take over your firm, I have to be able to afford to buy the stock. If your stock price is quite high, it's very difficult for me to buy enough of your stock to take over your firm. Does that make sense? When would it be easy to take over your firm? When the stock price is low. How does the stock price get low? Bad managers. So what does the CEO have to do in order to keep from getting taken over? Needs to keep that share price high enough to keep from becoming an attractive takeover target. Right? It's kind of like Roy having to work just enough to keep from getting fired. The CEO has to keep that share price high enough not to get taken over. And here's why. What do you think is going to happen to the CEO after the takeover? Yeah, it's going to get fired. Very few CEOs survive. I know of two. Number one, Jamie Dimon, who's now at JP Morgan. He was actually, JP Morgan bought Bank One in Ohio just to get Jamie Morgan, because Jamie Morgan was the CEO. And Halliburton merged with Dresser because one of the things they wanted out of that deal was William Bradford, the CEO of Dresser, to become the CEO of Halliburton. But most of the time, even if the CEO was doing even a half decent job, they're still going to lose their job. So that's why the market for corporate control helps to control their behavior. And then finally, we have monitoring. Monitoring. What's monitoring? What's that?
Overseeing?
Yeah, overseeing, being watched. So you walk into Taco Bell and you look up and you see cameras, right? Now, who are they really watching? The managers and the employees. So I was telling this to a night class one time, and I had a guy sitting in the back where Mr. Gaither is, and I said, you know what the most important camera in all of Taco Bell is? And someone guessed dining room because of the good fights, right? And I said, no, that's entertaining, but that's not correct. I said, it's the one behind the register. And they're like, huh? Why is the one behind the register the most important? Yeah, employees steal from you because employees are people and people are scumbags. Okay, now, the guy from Taco Bell, the guy sitting in the back row, was just busted out laughing. I said, what's up? He says, I'm a manager at Taco Bell. He says that camera behind the cash register is the only one at our store that works. Yeah. Now, hopefully they fix the other cameras. Don't get into a fight in the dining room just to prove a point. Now, monitoring. How about monitoring for CEOs? Well, you remember earlier I told you if I had $1 billion idea, it wouldn't be worth it to me to chase this guy down because it would only bring me $1? Is it worth my time as a 1 billionth shareholder to follow this guy around and see what he's doing? No. Now, what if I owned 40% of the firm? Would it be worth my time and money to monitor the CEO and make sure they were walking the line? Absolutely. And so we end up with what's called the free rider problem. The free rider problem. At companies where there is a big block holder, that's what we call these people that own a lot of state shares, a big block holder. The small shareholders will act as free riders on the monitoring that the big shareholder does. Given that I am A, not hugely wealthy, and B, that I hold a very diversified portfolio, I am a free rider at every single company I invest in. I'm just hoping there's someone out there with 40% or 20% that's willing to go out and follow this person around and hold them to account. For example, previous CEO of GE. It was found out by one of these large shareholders that the CEO not only had a Gulfstream 5, by the way, Gulfstream 5, is that a nice plane?
Yeah.
Yeah, we're talking sweet. Okay, not only has he got the Gulfstream 5 that he travels everywhere on, oh, and it's important because of the high value of his time and the need for security and all sorts of other things, but not only that, there was an empty Gulfstream 5 that followed him wherever he went. Why do you think he had an empty Gulfstream 5 that would follow him wherever he went?
Is it decoy?
Ooh, I don't think he was under missile attack, but I like the way you're thinking.
We can.
Because he can, okay, that's true. His rationale, well, what if the first jet breaks down? Like, well, then you go buy your ass a ticket like we all do, right? No! Oh, no, I couldn't do that. So he's got this, he's wearing out 2 private jets at the same rate. Isn't that sick? Now, how do you find such things out? You could hire people to follow him around. You could look at FlightAware. It's an online thing we have now, and you can see that these 2 planes always go together. Gee, I wonder why that is. In fact, I love this where they track all these Hollywood celebrities that are all talking about climate change and how we need to go carbon neutral. And then what do they get on to go to their next thing? Private jet. Really? Right? Look, either stop yapping about this or stop flying in that, but don't do both. That's hypocrisy. Okay. For next time, we will be talking about chapter 3. You need to read it. And by the way, that homework that's due Sunday is over chapter 2. And by the way, now you know everything you need to know in order to do homework 1. So you don't need to take advantage of that extension. You can go take care of that today. Any questions? Okay, I'll see you next time.